Welcome to today's Explainer. We're looking at something literally almost everyone knows about, but surprisingly few people actually know how to use strategically. I'm talking about gold. Now, for generations, it's been this ultimate symbol of wealth and culture, right? But today, we're completely shifting that perspective. We're going to take gold out of the jewelry box and place it right smack in the core of your modern investment portfolio. By the end of this explainer, you're going to see gold as way more than just a mere tradition. You'll see it as a dynamic, modern asset that builds some serious resilience into your savings.
Here is our roadmap for today. 1. More than just tradition. 2. The case for gold now. 3. Your financial shock absorber. 4. Gold versus equities. And 5. The modern gold portfolio. All right, let's jump right in. Section 1. More than just tradition. Okay, let's dive into this. For generations, people, especially families in India, have had this incredibly deep emotional connection with gold. You know the drill. It's handed down at weddings, gifted during festivals, and kept safe as this precious family heirloom. But if we only look at gold through that traditional lens, we are totally missing out on its true financial superpower. Let's be real. Today's economic cycles are wildly unpredictable, and markets are more volatile than ever. So allocating gold wisely, it's not just about keeping a cultural norm alive anymore. It is about making your savings fundamentally bulletproof.
To really get this shift, we got to look at how the asset itself has evolved. The old way of investing in gold, well, it meant buying physical jewelry, heavy coins or gold bars, and then paying a premium to stash them securely in bank lockers. It was kind of clunky and honestly a bit stressful with all the storage and security concerns. But the new way, it's entirely modern and super accessible. We are talking about digital gold, gold ETFs, and sovereign gold bonds. These modern options have completely transformed gold into this incredibly flexible, highly liquid asset class. It's a total game changer for how we can hold it in our portfolios.
Now, you might be asking yourself, why do we even need this new way to hold gold? What's it actually doing for us? Well, the true strategic value of gold comes down to this one simple concept: low correlation. So what does that mean? Basically, low correlation is a relationship where one asset tends to go up when another asset class, like equities or bonds, goes down. Think of it like a seesaw. When the stock market tumbles, or when inflation spikes and paper money loses its value, gold does its own thing. It actually tends to rise. By adding a low correlation asset to your mix, you are actively dialing down your overall volatility. It's literally a mathematical hedge.
Section 2. The case for gold now. Knowing what gold does in theory is great, but seeing what it's doing in the real world right now, that is entirely different. Let's shift over to our current economic landscape and look at exactly why gold is seeing such aggressive momentum today.
In just the last few years, gold has experienced a frankly unbelievable surge. Let's walk through this timeline together. Back in 2023, gold prices rose by 13%. Nice, right? But then in 2024, they jumped another staggering 27%. By 2025, prices crossed the monumental threshold of 1 lakh rupees per 10 grams for 24-karat gold. And as we map this momentum all the way up to our current reality in 2026, we have seen prices touch a whopping 1,40,000 rupees per 10 grams. This isn't just some slow, steady climb, folks. This is accelerating momentum. And this brilliantly illustrates our main point. That massive recent milestone of 1,40,000 rupees per 10 grams isn't just some random number. It tells us a very clear, very human story about investor psychology. In times of chaos, unpredictability, and global uncertainty, investors all over the world instinctively turn back to gold. They're treating it as this universally trusted safe haven asset. It's liquid, it's recognized literally everywhere, and it consistently shows up to work when other markets start to panic.
Section 3. Your financial shock absorber. Because of that exact behavior, the best way to think about gold is not just as a tool to build wealth, but as your very own financial shock absorber. It cushions your wealth when the financial road gets incredibly bumpy.
Let's break down exactly how this shock absorber functions. First off, it's an amazing inflation hedge. When inflation goes up, the real value of your cash drops, but gold tends to rise right along with it, maintaining your purchasing power. Second is diversification. Because it behaves totally differently from stocks, it significantly reduces your overall risk. Third, it's a crisis protector. It performs remarkably well during turbulence when fear is basically running the market. Fourth, liquidity. Unlike trying to sell real estate, gold, especially digital gold, is highly liquid and easily tradable pretty much any time. And finally, stability. You're not buying gold to chase quick overnight returns. You're buying it for that consistent cross-generational demand that gives you long-term peace of mind.
Section 4. Gold versus equities. Now, any smart investor is immediately going to ask, okay, but how does this stack up against the stock market? And that is a totally fair question. We all know equities are essential for long-term growth, but let's put them head-to-head with gold so we can see the full balanced picture.
Now, what's really interesting about this data is the trade-off between growth and protection. If we look at the 10-year rolling returns since 1984, the Sensex has delivered 13.55%, while gold sits at 9.85%. So what does that tell us? Well, it shows that in nearly two-thirds of cases, equities are absolutely going to outperform gold over the medium to long term. Equities clearly offer higher returns, but remember, they also carry higher risks. Gold isn't stepping in here to beat the stock market on a sunny day. It's there to be the ultimate protector of your capital when things like economic uncertainty, geopolitical tension, or currency depreciation strike. But prepare to be surprised. If you actually stretch that timeline way out to a very long 25-year horizon, gold has actually delivered an annualized return of 12.55%, slightly outperforming the Sensex's 10.73% over that exact same period. That is a massive takeaway. It completely proves that gold isn't strictly some defensive play that just drags your returns down. Given a long enough runway and the natural, inevitable cycles of global crises, gold can absolutely hold its own as a powerful growth asset.
Section 5. The modern gold portfolio. Let's move to and see how this builds into our final and definitely most actionable step. We've got the data, we understand the benefits, but how do we actually apply this to your own life and your own money? It all comes down to this one direct question. How much gold should you actually hold? You don't want too little, or you completely lose that shock absorber effect we just talked about, but you definitely don't want too much, or you might miss out on the compounding growth of equities.
So the crucial point comes down to finding your perfect balance. Now, there is no magic, one-size-fits-all rule here because it obviously depends on your personal financial goals, your risk appetite, and your investment timeline. But generally speaking, financial advisors recommend keeping a gold allocation of 15 to 25% of your total portfolio. This specific slice perfectly balances the growth potential of your other assets, like your stocks, with the rock-solid stability and protection that gold provides. It basically ensures your portfolio isn't dangerously overexposed to wild market swings, but is still perfectly positioned to grow steadily over time.
And hey, remember those modern methods we talked about earlier? Securing that 15 to 25% allocation is now entirely hassle-free. You can use digital gold, which is securely stored by trusted refineries, and you can start investing with as little as 100 rupees, literally the cost of a snack. You can buy gold ETFs and mutual funds, which give you the total ease and liquidity of trading right on the stock exchanges. Or you can opt for sovereign gold bonds issued by the RBI, which actually pay you an interest rate on top of whatever the gold value appreciation is. The old barriers to entry are just completely gone.
At the end of the day, gold is not just about numbers, charts, or percentages on a screen. It's about psychology. In every single financial crisis over the last 50 years, when fear completely dominated and trust in paper assets dwindled, human beings instinctively turned back to gold. Why? Because it's universal, it's liquid, it's portable, and above all, it is deeply, inherently trusted. Look, markets are always going to rise and fall. Policies will change, and currencies might weaken. But gold has proven it can stand the test of time.
Whether you're a totally first-time investor or a seasoned pro just looking to rebalance your assets, giving gold a strategic 15 to 25% space in your portfolio is all about building unshakable resilience. I want to leave you with this final thought today. Don't wait for the next crisis to knock. The smartest time to own gold is before the storm. So ask yourself, is your portfolio truly prepared for the next global shock, or are you just waiting for the rain to start pouring before you finally go buy an umbrella?